Good morning. I'm Suzanne St. Pierre, the chair of Venable's New York Real Estate Department. I'd like to welcome you to the latest installment of Venable's post-election webinar series. Today, we are going to talk about the results of the 2020 election and how the election may affect real estate investing in the future. Today's featured speakers are Mike Bloomquist, a partner in Venable's Legislative and Government Affairs Group, and Brian O'Connor, the co-chair of Venable's Transactional Tax Group. Mike will start with a discussion of the election results to date and what to expect in the next 60 days. Then we'll turn to Brian, who will describe some of the expected business, individual, estate, and capital gains tax reform proposals of the incoming administration. And then we will discuss how these proposals may affect real estate investments and real estate investors. At the end of the presentation, we will take questions from the audience, which you can send in during the presentation by typing in the question box, which should be visible on your screen. Mike, please take the floor.
Thanks, Suzanne. Let me advance to our first screen. I think as everybody on this webinar knows, we just went through a exciting and I think much closer than expected presidential election. President-elect Biden is all but certain to be certified as the winner with 306 electoral votes, the same number that President Trump got back in 2016, which is President Trump has not conceded. I don't know if we will ever get an actual concession out of him, but he has said that he would honor the Electoral College's certification of a Biden win. The Senate, however, is still undecided. Republicans held a bunch of seats that in North Carolina, Iowa, and Montana that were all projected to be in play, and they picked up a seat in Alabama. The Democrats flipped and defeated Republican incumbents in Arizona and Colorado. But as you probably read, Georgia is in play. They have both a special election that's being fought at the same time as their every 6-year election. So that is why 2 seats are up at the same time. And so Senator Loeffler and Senator Perdue are going to try to hold on to their seats in a January 5th runoff that'll determine control of the majority in the Senate. So if they both lose, it would be a 50-50 Senate with Vice President-elect Harris coming in to break the tie. So super narrow majorities if the Democrats win both those races. If the Republicans just win one, then the Republicans will continue to be in charge of the Senate, have full control of the Senate floor, but also probably have their own difficult time moving things in divided government and with a narrow majority. Over these next couple of months till the president-elect is sworn in on January 20th, we're going to see increasing intensity down in Georgia with proxies coming in from both national Republican leadership as well as the Biden campaign. On the Hill, most of the attention is focused on the government funding bill, temporary funding bill runs out on December 11th. And what will happen is Congress is going to negotiate either full year appropriations bills that will go till next September 30th, or they will do that for some of the appropriations bills, but not others, and just basically extend funding at current levels where they cannot reach agreement. Or Congress will say, this is all just too hard, there's not enough time, we'll do another short-term funding bill at current levels until March. With the surge in coronavirus cases happening all over the country, there are also more and more representatives and senators that are testing positive. So Speaker Pelosi in the House, for example, told the House members, don't come back till Wednesday, expect to work through the weekend, and we're just going to push through and try to wrap everything up next week. So that makes a big COVID deal right now more difficult just in terms of timing, and we're probably likely to see something on that next year. There's also the looming presence of the presidency is, and what President Trump will sign kind of affects all the negotiations on both sides, whether it's for the COVID relief package, what goes into the must-pass Defense Authorization Act, or the question of whether we do a continuing resolution or whether they end up passing appropriations bills. What will the president sign? Always a question. If things hold and Republicans hold the Senate and Democrats, of course, hold the House, with a much smaller majority, I think I read it was the smallest in almost 100 years. It'll only be a 5-vote majority for Speaker Pelosi. So she's going to have to really tend to her majority, protect her vulnerables, but also I know from being on the Republican side of the aisle when we had narrow majorities, it gives small groups within their caucus the ability to exercise much more power than they have when there's more of a cushion and a larger majority. So Speaker Pelosi is really going to have to thread the needle going forward. Senator McConnell, he's pretty much used to having a very narrow majority. He would obviously continue to exercise incredible power over what bills go on to the Senate floor, and it would probably have the effect of moderating what nominees or what people are nominated for Senator Biden's cabinet and for Senate-confirmed positions in the Biden administration. And so with that, I will kick it to Brian.
Thanks, Mike, but I'm not going to let you go quite so fast because I wanted to get your reaction to a couple of assumptions that I've had and members of my group have had. So first is in Georgia that what I'm hearing is it's likely that either the Republicans will take both seats or they will lose both seats. The likelihood of taking one and losing the other probably is relatively low. I wanted to get your reaction to that first.
I mean, really the wild card here is, can something happen with the president that so turns off his most fervent supporters that for some reason they do not show up to the polls? That would be how they lose both seats. If you combined both Republicans that were competing for Senator Loeffler's seat, they easily trounced the Democratic challenger. And then Senator Perdue in the runoff didn't achieve the 50% mark that would be needed to avoid a runoff, but I think he was at 49.8 or 0.9%. So he had about 2 or 3 percentage points better than the challenger, John Ossoff. So I think that's a reasonable assumption. I mean, you know, there is a certain amount of people did show more of a proclivity to split their voting than I think the political scientists had told us or even done anymore. And the cases in point for that would be Representative Don Bacon's seat out in the Nebraska 1st District, where Biden won the district handily, but Bacon, the Republican incumbent, won by about 8 points when we're well ahead of the president. Same in Maine, where President-elect Biden easily won Maine. The voters chose to send back Susan Collins by a comfortable margin. So perhaps voters in Georgia would vote for one candidate and not the other. But one thing of note is both pairs of candidates in Georgia are running as teams. So I think both parties have decided they're going all in, for either you take both of us or rather than it being pick one and not the other.
Interesting. And the other assumption that I'm having and members of my team are having is that if, let's say, the 2 seats went blue and we had a 50-50 split, that is not likely to be enough to really get behind dramatic action as far as tax policy is concerned, because it would just be too close of a margin, and there might be some on the Democratic side that would resist overly dramatic tax change and probably overly dramatic change in general. And part of what this all leads to is that up until the election, of course, many of our clients were very, very concerned about what they might need to do in 2020 to lock in the certainty of the 2020 tax system and the 2020 tax rates. And there was a growing, you might even call burgeoning mad rush of many of our clients to do a lot of estate planning and in some cases recognize taxable income and taxable gains early to get the benefits of the 2020 rates. And even though there's still certainly the prospect of a 50-50 Senate and a lack of Republican control, that mad rush has subsided significantly, and that there's still some that they, of course, want to do what they can by the end of the year to get the assurances that they can get by doing that. But there seems to be an expectation that even if the Dems win those two seats, that there's not going to be dramatic change on the tax side. So there isn't the same level of concern about getting things done by the end of the year as far as tax planning is concerned. Now, one of those things could be the issue of retroactivity. So let's say there was a tax bill with a lot of the changes that I'm going to be talking about in a few minutes. The timing of that, if something were to pass in the summer or in the fall, the political ability as a practical matter to relate those changes back to the first of the year would be very limited in a 50-50 Congress. I'm sorry, 50-50 Senate. But wanted to get your thoughts on that too, because that's something, of course, that a lot of my clients are focused on. They have a sense that they don't need to undertake dramatic change before the end of the year. There's a sense that if there is going to be some change in the tax landscape, it'll be not effective as of 1/1/21. It'll be effective 1/1/22 or some other time during the middle of the year. But in either case, there'll be time to act in 2021 to protect against potential changes in the tax law, as opposed to having to do everything between now and December 31st. I threw a lot at you, Mike, but I was curious about your thoughts on those points.
I think painting in broad brushstrokes a 50-50 Senate where the Vice President Harris would come in and break the tie, giving control to the Democrats. I think painting with broad brushstrokes, you can say that would really put a damper on the ability to do big things. And by big things, I mean Green New Deal, Medicare for all, massive overhaul and rejection of the Trump tax cuts. I think that's definitely true. Now, I would say that one thing I think you will see in a highly partisan, remember the members that lost in the Democratic side in the House were the ones that were more moderate, and for the most part. And so I think you're going to see a very progressive, very ambitious House wanting to signal to their party's base that they remain committed to issues like climate change and health care for all. And I'm sure they would love to, at some level, reject what the Trump administration did in the tax area. In order to, this is probably getting into too much detail, but in order to actually affect, or for those things to have a chance to pass, they're probably going to have to be severely moderated in order to get the 50 votes, like you said, in the Senate. That people like Senator Manchin from West Virginia is very, very moderate, or senators that are up for re-election in 2022 who might not be comfortable taking super progressive votes. So they're going to be moderated. In the tax area, it's, I think, a little bit different in the sense that you're going to need to use the reconciliation process, which means Congress first, in order to get a smaller number in order to avoid a filibuster in the Senate. So that means you first have to pass a budget. And I think that in and of itself is going to be really hard with these narrow majorities. I think it's going to be incredibly hard to get the progressives and the moderates and kind of the more traditional Democrats all on the same page in order to prioritize a budget that then they can use the expedited consideration for that budget to carry tax changes. I think that's just going to be very hard going forward, even in a Democratic-controlled Senate.
And along those lines, and this ties into one of the more significant things on the tax side that I'll talk about. So is it safe to say that the doing away with the filibuster, which I guess is still theoretically possible with a 50-50 Senate, is not something that we should expect to see?
I mean, I think it'd be it's a lot harder in the 50-50 Senate. I will say that the Senate Majority Leader McConnell and the candidates in Georgia, though, are reminding everybody that they can, whether it's in fundraising or it's on the ground for the votes in Georgia, that if you elect both Georgian Democratic candidates and the Democrats have control, they theoretically could, and then they parade the horribles. They could do away with the filibuster. They could pack the Supreme Court. They could admit Washington, D.C. and Puerto Rico as new states, gain 4 more Democratic votes. They're making everybody aware that that is a possibility.
Sure, and one of the things that I don't think has gotten very much attention on the tax side, but it's an incredibly significant tax change, is the lifting of the Social Security cap. I know this is a real estate program, but still folks in real estate can end up getting salaries or guaranteed payments or other amounts that are subject to employment taxes. And under the current regime, we all pay the full Social Security rate, which is 15.3% on everything up to the wage base amount, which for this year is 137 and change. And then the Social Security piece, the 12.4% of that 15.3% amount, is no longer paid for anyone receiving a salary or service payments in excess of that wage base amount. So what's been proposed by the Biden campaign is a restarting of that 12.4% Social Security tax at $400,000. So you would have somebody who made $500,000 of salary would pay the full freight on the first $137,700, and then would not pay the 12.4% component of that until they reached $400,000, and then they would pay that again. That would be a very dramatic change in our tax system, and would be a very significant tax increase for wage earners above $400,000. That in itself is a 12.4% increase in addition to the other increases that we'll talk about. But that could only happen if there was a breach of the filibuster, because that cannot go through reconciliation. So, and Mike, I'm raising this for your input and your thinking on this. That's been my understanding. So that change, while dramatic, is less likely because of the need for the filibuster to be removed in order to, as a practical matter, execute that. I guess I'm reaching out to confirm that's your understanding as well.
That would be my analysis as well. That without a bigger margin, if the Democrats had a 3 or 4 vote Senate margin, I could see getting rid of the filibuster being a much easier lift for them. But in a super tight Senate rather, I think that would be difficult. As just a political aside, back when the payroll tax was paused during the Great Recession back in 2008 or during 2009, during that period, on the Hill, one of the things on the Republican side that people were worried about was that when they got into tax negotiations with Obama, he was going to propose kind of doing what you're saying, kind of basically getting rid of the payroll tax for everybody making below a certain amount, say, like you said, $400,000, and then just making it uncapped for everybody else to pay for that. And I know the people the staffers on Ways and Means there said they were really surprised at how many Republican members didn't think that was the worst idea. And so I don't think that's going to happen, happen these days and with this package. And like you said, it would need to get 60 votes in the Senate anyway. But I just thought that was interesting. It was almost like some green shoots of populism back in 2009.
Interesting. One last point to make on that, and then I'll move on to the other aspects of the Biden campaign's proposals. So the wage base amount is increased by an inflation adjustment every year. So that goes up every year. The $400,000 amount would not be indexed, so that gap within which the tax wouldn't be paid will shrink over time to the point where the Social Security cap is entirely lifted. Obviously that would take a number of years to happen, but eventually it would go away. One of the things that I found just observing tax policy changes is that from a revenue enhancement standpoint, one of the most effective techniques politically is to set a tax at a level where a good percentage of the population believes that it's not going to impact them, but then don't index that amount. And then every year, of course, with the benefit of inflation, that tax captures more and more people. One of the best examples I ever saw in my practice on that was there's a provision that if you have an installment sale that is in excess of $5 million, that a special interest charge tax applies to that installment sale. And that $5 million amount was never indexed. And at the time it was instituted, that was considered a very, very big sale, $5 million. So it didn't have the political blowback that it might have had otherwise. Well, almost 40 years later, a $5 million sale is not terribly unusual. So that tax can capture a lot of transactions now that it wouldn't have captured back in the 80s when it was enacted. But in any event, I digress with that. Let me go and talk about more of what's been proposed by the Biden campaign, with the understanding that, based on what Mike took us through, most, if not all, of these proposals are not likely to happen anytime soon. And I guess maybe I could say they're not likely to be in place effective 1/1/21. We'll have to see what happens, but there's likely to be an opportunity next year to work around these provisions if that is something that someone would like to do. But of course, that's not something that anyone can guarantee. There's always the prospect of retroactive tax legislation. We have seen it in the past. I wouldn't think it would be likely under current circumstances, but it's certainly not impossible. Okay, so having said all that, the Biden campaign has the goal of course, raising trillions of dollars and not having any increases for anyone who has taxable income of less than $400,000 a year. So all of these increases that we're going to be talking about are targeted to land on the top 1.5% of taxpayers. So that's perhaps good news, subject to the lack of indexing that I talked about for anyone below 400K. But it's potentially very, very dramatic news for folks above that threshold because the increases are rather far-reaching. Certainly the most far-reaching that I've seen proposed since I've been in practice, and I'm at about 30 years of practice. So this is novel in its reach, certainly much more far-reaching than what had been proposed by the Obama administration. But with that, let me move the slides. Okay. And when I talk about business taxation first, real estate tends not to involve corporate entities. Most real estate transactions and investments involve flow-through vehicles like partnerships or LLCs. But for those that do have some type of a C corporation element within their mix, the Biden campaign has proposed to increase the C corporation tax rate from 21% to 28%. That is a 33% increase in the tax rate, which is, of course, significant, but it's still not quite where it was before the Tax Cuts and Jobs Act of the Trump administration. Originally, that rate had been as high as 35%. There's also a suggestion to bring back some type of corporate alternative minimum tax, which was done away with by the TCJA. So there'd be a return to a minimum tax concept. Because this is a real estate webinar, I'm not really going to get into the international tax provisions that have been suggested by the Biden campaign. They're in the deck for everyone's reference. And of course, there could be those that invest in real estate in other jurisdictions, but too much for me to talk about, so I'm going to have to skip that. And when I take it to the next slide and talk about probably the biggest things that would impact real estate investment, other than, of course, the rates, is the suggestion to do away with Section 1031 like-kind exchanges. Right now, under current law, if I sell real estate, I can reinvest the proceeds from that sale into new real estate, and I can avoid paying tax on the sale of the first real estate. Very, very common technique in the real estate industry, and the 1031 rules were restricted in the TCJA for 2018, but they still applied as to real estate, and it is still a viable technique and a very, very common technique in the real estate marketplace to use 1031 exchanges. The Biden campaign has proposed to do away with those. Another item that's relatively enormous for the real estate industry is the suggestion to do away with the step-up in basis upon death. And what that rule allows is that if a taxpayer passes and bequests a piece of real estate to a family member, the tax basis of that real estate is adjusted to fair market value as part of that transfer. So all of the inherent taxable gain inside that real estate asset essentially evaporates. And so often tax people will joke, and you know how funny tax people can be, but they'll joke and talk about how the best tax planning technique is to die, because if you've got a big inherent gain in a piece of property that you don't want to pay tax on, and you would pay tax on it if you sold it, if you give it to a beneficiary upon your death, well, that gain essentially evaporates, and it never gets taxed. And that's the step up in basis. Now, of course, that does benefit the wealthier among us, much more so than those that don't have assets to pass on to heirs. And that's why it's become a target of the Biden campaign. As a little bit of an aside, and showing how these two provisions, the 1031 exchange and the step up in basis, can be so important in tax planning. I've had a number of people call me over the last few months saying, hey, I heard that Donald Trump only paid $750 in taxes. I want you to do that for me. How is it that I can just pay $750 in taxes? And one of the things I will talk about, without, of course, knowing the details of President Trump's tax return, What I can tell them is that in the world of real estate, it is not uncommon for real estate investors, real estate entrepreneurs to pay very little in tax. And the reason for that is if you're constantly buying real estate assets, you're getting significant amounts of depreciation from those purchases. You probably have a fair amount of debt on the real estate because it seems like most real estate has debt attached to it. That debt is producing interest deductions. So between the depreciation and the interest, you get a lot of tax deductions that often can permit you to have a greatly reduced tax liability if you're very heavy in the real estate business. There's a lot of restrictions on the deductibility of these items. If you are a regular person, but hey, if you're a big-time real estate entrepreneur, you can take advantage of a lot of things that often permits you to pay very little in tax. And when it comes time to sell a real estate asset, you would do a like-kind exchange and avoid the tax on that gain. Another helpful way to keep your tax bill low. And then after you've built up tremendous gains in all of your real estate over your lifetime, you would pass them on to your beneficiaries with a step up in basis. And of course, all that gain would not be taxed. If you could do that, if you can work that system through, you probably wouldn't pay as much tax as most of the rest of us. So that is something that has been available for real estate entrepreneurs since there has been an income tax. And doing away with the 1031 exchange rules and the step-up in basis would put a substantial dent in that type of planning. So that is why those items are kind of front and center in the Biden campaign's proposals, and why those are probably the two of the biggest takeaways from this webinar that I would want everyone listening to have, is that 1031 exchanges and step-up in basis would have a serious impact on the ability of those of us in the real estate world, the ability for those folks to reduce their tax liabilities. Having said that, when I move to the next slide, and there's, again, more things here that are particulars of the Biden campaign dealing with new market tax credits, other types of tax credits, climate-related proposals. And for the sake of time, I'm going to skip those. They're certainly there for everyone's review. And I'm going to go right to the individual tax rate adjustments, because those are among the more significant things that remain to be discussed. So what's going to happen on the individual side if the Democrats are able to take the two Georgia seats and put together a tax bill? That tax bill would increase the top rate, which is currently 37%, to 39.6%. And, of course, that 39.6% is the same tax rate that we had under the Obama administration. So we would be returning to the old 39.6% rate. That really surprised no one. Certainly of all the things that were proposed by the Biden campaign, that was probably the change that was the most expected. There's a plan to do away with the Section 199 Cap A benefit for taxpayers over $400,000 in income. What the 199 Cap A benefit does is it gives what is effectively a rate reduction for a lot of business income from what would be the top rate, right now 37%. That rate is dropped down to 29.6% in many circumstances for business taxpayers, including taxpayers in real estate under certain circumstances. So a lot of business taxpayers are not paying that top 37% rate. They're paying 29.6%. That would be a change that would go away. Pretty material reduction by the Trump administration, and that would be bouncing back to 39.6%. And another item here that's important is that adjustment also applied to most dividends from REITs. Of course, we're talking about real estate, and real estate investment trusts are a big part of the real estate industry. Right now, the recipients of most dividends from REITs, individual recipients, get the benefit of a 29.6% rate on those REIT dividends as opposed to the ordinary rate of 37%. That would change as well. So you'd be looking at the rate on REIT dividends returning to a 39.6% rate. So that is effectively a 10% increase in those rates. We talked about the payroll tax increase and went through that. That is probably the most significant tax increase that's embedded in the Biden campaign's proposals. Hasn't gotten a lot of discussion, but when people talk about how a person living in New York City like Suzanne, who's on this call with us, might be paying tax rates on their service income that is well in excess of 60% after you take into account all the federal changes and Suzanne's New York City state tax, or state/city tax. That's what people are talking about, and a very big component of that is this, of course, this 12.4% increased employment tax that's going to land on taxpayers with income in excess of $400K if the Biden campaign's proposals become effective. One thing to say about opportunity zones, which is something that, of course, was a new provision during the Trump administration and the TCJA. The opportunity zones are slated to survive under the Biden campaign proposals, albeit with a incentive to have partnering with nonprofits and what one might say is greater accountability of the benefits, the social benefits that would come from a particular opportunity zone project. We're seeing a fair amount of opportunity zone work in our practices. There's a lot of opportunity zones around, particularly in places like D.C. and Baltimore and other cities that we spend a lot of time working in as part of Venable's East Coast practice. A lot of opportunities there, and it looks like even if there were to be a new tax bill, that those opportunities would survive, albeit with some tightening, perhaps, of the benefits that are available. Capital gains, let me go to the next slide. This is another big change. Yeah, so right now capital gains are subject to a 20% rate, ordinarily, a 25% rate for a lot of real estate transactions. If I were to buy a building for $100 and I depreciate it down to $80 and then I sell it for $110, I would have a $30 gain. 110 sales price, my tax basis went down to $80. There's a $30 gain. That gain under current law would be taxed at 25% to the extent of the prior depreciation. So 20 of that $30 gain would be subject to a 25% rate. And then the 10 gain over and above that would be subject to a 20% rate. And in both cases, I might have an additional 3.8% Medicare tax added on to the capital gains tax rate, unless there was some way I could achieve an exemption from that tax. So call it 23.8% or 28.8% as the likely rates that apply under current law. The Biden campaign proposes to tax capital gains at ordinary income rates, which would, of course, raise the tax rate for capital gains up to 39.6% plus the 3.8% Medicare tax. So you're talking about 43.4% capital gains rate. That would be a extraordinary change, to say the least. So that is something to be mindful of. That is out there, and of course that would impact the real estate industry quite significantly, particularly in conjunction with a removal of the like-kind exchange provisions that would allow you to avoid that gain in the first place. Other things to talk about. I'm going to advance
your slide here. Make sure you're.
Oh, thank you, Suzanne. Yeah, and I'm probably only going to continue for another 5 minutes or so because we want to leave it open for questions. And as I told you and Mike as we were getting ready for this, I could talk about this stuff for 5-6 hours if you all let me. So I'm not going to do that. But I will close out by saying that another dramatic change that is proposed to take place that would affect the real estate industry, in addition to other industries, of course, is the changes to the estate tax regime. Right now, taxpayers have to pay estate tax at a 40% rate or gift tax at a 40% rate if they make gifts and bequests over their lifetime exemption, which right now is a very healthy $11.58 million per person. So about $23 million per couple. And that's going to exclude a great many taxpayers from the estate tax system. The Biden campaign has proposed to dramatically reduce that lifetime exemption. They haven't been very specific as to what they would reduce it to, although there's been some suggestion that it would be reduced as low as $3.5 million per person. So we'd be looking at a total exemption dropping from $23 million to $7 million. Quite a dramatic change. And obviously a good number of additional taxpayers would be caught up in the system at that level. But still, at $7 million of wealth, there's a good many of us that wouldn't be caught in that system. And then in addition to the lowering of the exemption, dramatic lowering of the exemption, there's also the proposal to increase the tax rate. Again, we don't have all that many specifics on this, but certainly there's an expectation that the rate would rise in addition to the exemption falling. So big changes on the estate tax side because of that. And we've got some calculations in the materials that illustrate the potential effect of all that. And I guess one of the things that I'll close out with is that a few other small items, and I'm going to advance the slide up to those. Okay, we've talked about, I'm not going to go through the examples, but they're helpful to go through. Yeah, so I think the last things that I'll say is that there's been some other proposals that are smaller but not insignificant. One would be to make it so anyone taking an itemized deduction could only receive a benefit of up to 28% for that deduction. So if I give $100 to charity, my tax bill can only go down by $28, even if I'm in a 39.6% bracket. Without such a change, I'd be able to get a $39.60 benefit from that $100 donation. The Biden campaign has proposed limiting the benefit to any deductions for folks over certain thresholds to 28%. The restoration of the PEAS provisions, what does all this mean? The PEAS provisions are tax code provisions that would reduce your deductions as your income increased. So every dollar of additional income over a threshold, you would have to reduce a deduction. So it's really kind of a backhanded way to increase your tax rate without looking like you're changing the rates. So that was done away with in the TCJA. It's proposed to be restored by the Biden administration. So that's effectively an increase of about a 1.5 based on most estimates in the rate indirectly. And the last thing is, and this is something that could be very good news for taxpayers in high state and city tax jurisdictions. One of the things that the TCJA did was it eliminated the deduction for state and local taxes, except for up to $10,000 per return. So a big hit for jurisdictions like New York City and California that have very, very high state and local income taxes. The inability to deduct those taxes is something that the Biden campaign proposes to repeal. So that would be a good piece of good news that would provide some offset to the other increases that I just talked about, is we might be going back to a time where we can fully deduct our state and local income taxes as part of filing our tax returns. There's some other proposals out there that were not made specifically by the Biden campaign. Senator Wyden is talking about potentially a mark-to-market system where you would, at the end of every year, deem yourself to have sold all of your assets and recognize the gains and losses that would be attributable to those sales and be subject to tax at ordinary rates on all those gains or losses. That would be a rather dramatic change to the tax system, but that is something that has already some existence in some isolated parts of the tax code. That's something that people are looking at. There's also wealth tax proposals that have been made by Senator Warren. And what a wealth tax is a annual percentage that applies to your accumulated wealth, and it would be a tax every year that was paid. The numbers in Senator Warren's proposals are pretty high in the sense that it would be a 2% tax on wealth over $50 million and a 3% tax on wealth over $1 billion. So obviously this would reach only a small number of taxpayers. There are wealth taxes in a number of other jurisdictions. I think the thinking on their effectiveness has been mixed in that they do raise revenue, obviously, but they do also require a relatively significant increase in enforcement activities, and there's a lot of time spent trying to figure out what particular assets are worth. So there are some inefficiencies with a wealth tax regime. Well, Suzanne and Mike, like I said, there's much more that I can talk about, but I think it's probably time for me to turn it back over to the two of you all.
Thank you, Brian. For our audience, I'd like to provide the CLE code word, which is Real Estate 2020. We don't have any audience questions. If anybody has a question, please feel free to send it in. I have one question for you, Brian, going back to the payroll tax. Your slides indicate that the liability for that enhanced payroll tax will be split between employee and employer. Could you talk a little bit about the impact of that on employers?
Sure, and let me also clarify the full effect of that. So if you are an employee, you only pay half of the payroll tax. So the 15.3% total payroll tax, you only pay 7.65% of that. And anyone that gets a W-2 is probably very familiar with how that 7.65% comes out of their pay. If you're self-employed, like the three of us, Mike, Suzanne, and myself, you pay both ends of that tax. So you will bear the full burden, both the employee and the employer portions of that tax get paid by the same taxpayer. So that's where the effect of that on an individual level is going to be felt the most acutely is anyone who is treated as self-employed under the tax code. But back specifically to your question is that to the extent someone's an employee and is only paying half of the tax, the other half, of course, is borne by the employer. So this is effectively not only a tax increase on individuals, but it would be a tax increase on businesses, on employers. They would effectively see the employment taxes that they're paying on their employees increase to reflect the additional 12.4% tax that they're going to be picking up 6.2% of. So that is another, I would suggest that's another potential concern with this provision is it's also something that will weigh heavily on employers at a time where we might be stepping into a weaker economy.
Thanks, Brian. We did receive a question from the audience asking if this is eligible for CPE credit for CPAs. Was thoroughly enjoyable nonetheless. Thank you. Unfortunately, not being CPAs, we cannot provide programming that has credits for CPAs. So the CLE code that I mentioned a bit earlier is a continuing legal education credit for attorneys only. thank you for joining us. Brian, another thing that we talked about, which is not really perhaps so much an effect of the election or potential effect of the election, but rather a symptom of the economic situation that the country's in right now, is very low real estate values. And, by contrast to some of the proposals that you've been talking about, which, as Mike and you discussed, may or may not happen, these historically low, or at least in terms of recent history, these low real estate values do provide a current opportunity for real estate investors. Do you want to talk a little bit about that? We've been working with certain clients on actually taking this opportunity to actually enter into an event that would be a gain recognition event because it's a favorable climate. Do you want to comment on that?
Sure. And I think you're right, Suzanne. That's certainly something that has come up, and we just were talking about that earlier today, is that anyone who is interested in making some type of family gift or family sale for estate planning purposes has the benefit of a number of things working in their favor right now. And one is reduced real estate values, particularly in places like New York City. And for anyone who is concerned about their estate tax situation, particularly with the prospect of a lower exemption at some point applying, this would be a good time to transfer that real estate because they have the benefit of the current higher exemption amounts. They would have a time when real estate values are lower than typical, to the extent they were going to do some type of inter-family sale to a trust or something like that, that where the buyer would issue a promissory note. They also have the benefit of extraordinarily low applicable federal rates that would enable the interest rate to be charged on a finance real estate acquisition to be almost zero. I mean, it's incredible how low the federal rates are in the current environment. So, and also combine that with another thing that I can touch on briefly. Often when you're doing interfamily sales or gift transactions, you're taking valuation discounts on those transactions to reduce the purchase price if it's a sale, or the amount of the gift for estate and gift tax purposes if it's a gift. And one of the things that the Obama administration had proposed was regulations that would dramatically reduce the ability to take those discounts, which of course can be very, very helpful in family estate planning. The Trump administration shelved those proposed rules when it came in 2017, and nothing's happened on those rules during the course of the Trump administration. There's always the prospect that the Biden administration could come in and looking for revenue and the ability to act, even if they don't have control of Congress or the Senate. They could go ahead and, by regulation, follow up on what the Obama administration had already pursued, which would be the reduction in the ability to use valuation discounts in estate planning. So that's certainly something that could happen, and if that happened, it would be by regulation. It would be prospective only, but that's something that we could see in 2021, even if the Republicans maintain control of the Senate. So put all those things together, a certain tax landscape right now, a lower real estate values, a higher exemption amounts, extraordinarily low interest rates, and a relatively unrestricted ability to use valuation discounts. That does make estate planning right now ideal, certainly more ideal than any other time than I've seen in 30 years of practice.
Thanks, Brian. We have one other question from the audience, and the question is, what are the state impacts of these changes vis-a-vis decoupling?
And great question, because a lot of what happened when the TCJA was passed by the Trump administration is a lot of the states decoupled, and then there were recent changes under the CARES Act that a lot of states decided that they weren't going to go along with for state income tax purposes. And so that effectively is what a decoupling is that's when the state says, Fed, sure, you can do whatever you all want to do as far as changing the tax law, but we're not going to do the same thing for purposes of calculating your state tax, because we're going to separate ourselves and decouple ourselves from that. I would expect more of that, simply because it's real revenue for the states. If there's going to be additional changes that would impact what the state taxes would be, and it's certainly becoming more and more common. So I do think taxpayers have become relatively accustomed to it, even if they're not necessarily very happy about it. It's not a surprise, and some states have made quite a practice of decoupling. New York State, of course, has decoupled from a good number of the recent tax changes. So I'd expect that to continue. If anything, I would expect more states to decide to do that. I think that a lot of states will follow the lead of the higher tax states that have already done that, and I would expect the higher tax states to do that perhaps more aggressively than they have done it in the past.
Great. Well, I think that this brings us to the end of the presentation. There's obviously a lot in play here, and we will, of course, be sending updates and perhaps following up on this conversation as things start to unfold next year. Thank you, everyone, for joining us today. Thank you, Brian. And thank you, Mike.